Good evening and welcome, everyone. This is John Person, and we're talking tonight about a very special event, preparing for the end of the year and beyond into 2015. Of course, the information presented tonight is, without doubt, educational material. It's important to read this disclosure statement as being registered with the, most of you are aware, I'm still registered with the CFTC in the capacity of a Commodity Futures Trading Advisor, CTA as it's called. So with that said, take a second just to read this through, and I thank you for that. Okay, well, I'm not sure how many people are coming, but we will be this week, Friday. Tomorrow I'm actually leaving to Baltimore for it's the Fortune 500 CEO conference. I guess the CEO of Yum Brands will be there and a few other big wigs, and I'm giving a presentation tomorrow, Thursday morning. Excuse me, Thursday morning. I'm giving a presentation, so I'll fill you guys all in on what the event is what other presenters are talking about. Basically, it's a conference for CEOs, and my topic will be the impact of social media and the view of investors, I guess, relationships with the CEOs and how they do or do not use social media and what it brings to the table from a perspective of a trader. So, and after that, I'll be in Las Vegas this Friday and Saturday at the Traders Expo. It's being held at Caesars Palace. So if you're coming out, we look forward to seeing you. I know Sonia will be there in person. Sonia is one of our students and helps out. And so, any event, that's our schedule for the rest of this week. We have 28 and a half days left until 2015 of actual trading days as of today, if you include the half day, which the half-day Black Friday is really not really a half a day, but we all used to consider it a half a day. So we have Black Friday and Cyber Monday retail trades. Many of these big, I want everyone to, we're just going to come right out of the box and give you some insights here. A lot of retail trades do not necessarily include the department stores from a seasonal perspective, and we'll talk a little bit about that tonight, namely the outlook for like Nordstrom's, Macy's, et cetera, et cetera. That's what I mean by department stores. Another thing that we will be preparing for is a scan that we created in Trade Navigator. So many of you guys, if you are lifetimers or you've bought the Genesis package, what we'll be doing is we'll be scanning for stocks below the 50-day moving average. And as you can see in the S&P 500, there's about 82 symbols that are below their 50-day moving average. But there's another scan that we want to look at, and it's stocks that are actually negative on the year. So what we'll be looking for is stocks, just to give you an idea, typically speaking, if you're looking, and this may help you for trade decisions, if you think about it again, let's go back and look at this slide one more time. 28 and a half trading days left until we celebrate 2015. Half of this decade will be over in 28 and a half days. And bond prices and bond yields and interest rates are still with interest rates near 0%, and we're halfway through this decade. It took how many years for bonds to trade up, and how many months will it take when the bond market rug gets pulled will it take to go down? Typically, stairs take longer than an elevator going down, and so what I wanted to bring to your attention is the fact that we do have some really monumental trade events that will be taking place that I think every investor should be and can, more importantly, prepare for if you know what to look for. So what the point is, basically, stocks that have a tendency, like I'm just going to pull out Apache, stocks that have a tendency to be already negative on the year. So, like for example, we take a look at Apache, which last year it closed here at 85.94. Currently, it's at 72.07. It really doesn't even have to begin a seasonal tendency to spike up until really after the first of the year. Now, the funny thing about that is the best time to buy even this sector, the absolute, there's some up and downs going in there, but really it's in the end of February. But here's the key that we want to pay attention to. Due to our tax structures and our tax laws, typically traders will be selling stocks that are negative going by the middle of December. By about the second week of December, that's when most funds and most professional institutions, they're done for the year. I mean, if you haven't made your money this year by middle of December, and remember, let's take a look at a calendar and start thinking ahead. That's what tonight's really all about, is to help you prepare for these typical seasonal events. And it's not just, buy on Yom Kippur, sell Rosh Hashanah. I'm talking about the end-of-year seasonal tax implications and thinking ahead. Now, dogs of the Dow is a concept, but also stocks that are negative on the year, especially as we're towards the middle of the month. And keep in mind, Hanukkah this year begins at sundown on December 16th, and that's about the second week, the middle of the month. So after Hanukkah, we're done for the year pretty much. So any stock that's down on the year and continue, will have a hard time to rally because people will want to do what's known as sell, if they haven't already, and assume that tax credit for that loss for a tax credit. So what we want to do is plan ahead going into next year and start making a shopping list of stocks, which we've done for many years in a row for our trading community. And what we're looking at is stocks that are down on the year. They tend to stay down on the year because rallies would be sold. People want to just, get out of those positions. And then what happens towards the beginning of the year, they end up getting right back in those stocks. And so we want to look for stocks that have gotten beaten up real badly towards year's end and that have a seasonal move to the upside, just like with, Apache. Now, it's in the oil, gas exploration, and it's a no-brainer. This sector has just gotten crushed. But just to bring to your attention, the best time of the year to really even get in, and you can see the strongest trend of the year is in late March. But as we get past that January sell-off, at least we'll be focusing our attention into that stock or that sector for a seasonal and also as well as a attractive buying opportunity as people that are getting back into that sector that had sold for the end of the year tax credit reason, they'll be getting right back into that trade again. Another stock in, like I was just saying with the retail sales and Black Friday and Cyber Monday, is the department stores. And here's one that we kind of mentioned this in our trading room today, is JCPenney. Now, JCPenney's, the interesting aspect is we played Sears and JCPenney's. We played it earlier this year, and we did quite well because it was that little pop that we got at the beginning of the year after that January typical sell-off. We had a nice little pop in JCPenney. Now, here's the thing. Here's another example of a stock that is absolutely, it's only down 20% year to date only. Listen to me. But if you notice that as you get into Cyber Friday or Cyber Monday and Black Friday, it traditionally, JCPenney's doesn't really bode well despite all the other woes that JCPenney's has and that sector. Notice that it doesn't even begin a seasonally strong period of time until the end of January, and it has a really strong, pronounced seasonal trade to the upside, which brings me our attention to Macy's. Now, Macy's is another one that sector, as you can see, as I'm showing you in the middle of the chart here, and just so that you can see exactly, hopefully you can see exactly where I'm pointing to right here. Typically, Macy's and even that whole department store, it really doesn't even perform well until the strongest, the same thing, the same type of seasonal tendency until after the first of the year. So it's not really going into Cyber Monday that it does well. In fact, one of the problems that I see facing this stock and specifically the department store sector is not only has it had just this year a significant advance, this could be the opposite effect where it won't really go down a whole lot until after the new year because it has had a nice little gain. It's kind of the opposite. Stocks that have underperformed all year tend to stay underperformed until the beginning of the year. Stocks that have outperformed all year tend to remain high because who in their right mind wants to take a tidy profit in a stock, at the end of the year and to only have to write a check to Uncle Sam 4 months later? If you just wait until after January to take a profit on some of these stocks, guess what? You defer that for another 13 months and you lay off that tax liability until April of 2016. So there is a funny thing here is that you see a very strong tendency for Macy's to drop. It doesn't really go anywhere, but it has a strong tendency to drop going into the end of January, and then it starts its annual move. Now, the problem that I have here with Macy's in this sector, and it's not just Macy's, as you'll see in a moment, is that this whole move this year has come on a very lackluster volume. It's not moved, and we take a look at this tool here called on-balance volume. It hasn't really accumulated a lot of volume on this rally this year. So that tells me that the upside will be limited and that when they do decide to take profits towards the beginning of January, it could be a more pronounced move to the downside. So let's just say we get a little advance to the upside. People get a little bit excited about, Macy's going into the end of November into December, the first week of December. Let's say that market goes up and maybe tests that pivot resistance near 66. Based on this volume activity here, newer highs on the daily charts, as you can see. I mean, we've got testing the highs for the year, and there's just no volume participation in this stock. And if you do have heard of the phrase, volume is the lifeblood of market and volume precedes prices, this to me suggests that Macy's will have problems continuing to advance as well as maintain that high price structure. And this would be one that would be prone to a major profit-taking liquidation. And so this is just some of the stuff that we will be looking at as far as trading opportunities and as well as stocks to avoid in the next few weeks. All right. So that is one of the things that I think that first and foremost that we need to start to think about, because I know we're all wrapped up into maybe this week we have option expiration and everyone's talking about maybe this is the Santa Claus rally and there's Santa Claus over there. I think it's really just jokingly, I think that's Tom Sosnoff in disguise over there. But he's Santa's this little rally here. Maybe this is a little early Santa Claus rally. But two things. We got to watch out for getting into the hype of the Black Friday Cyber Money retail trades because it does not necessarily include the department stores, as I just had mentioned, especially looking at Macy's and JCPenney. Dogs of the year, we got to prepare and start looking for negative performers into the middle of December, and they tend to rebound sharply after the new year. So we got to start to populate a list of these candidates. Another thing is that markets tend to rebound from the November lows, which include the small cap sector, and you call that, or you're familiar with that, as the January effect. As we head into the first 2 weeks of January, typically small cap stocks tend to outpace the brethren blue chips. So that spread we'll be looking at one more time. We're long the Russell, short the either Dow or short the S&P 500. So there is 4 little things that we want to start focusing in on that we can create stocks that may give us an opportunity for some credit call spreads, and stocks that because they may have more pressure to the downside, then these are stocks that we may want to take a look at some buying opportunities in that last week of December for maybe a stock replacement for a February expiration. So what I'm looking at is that a stock that gets really pounced and it's down negative on the year, if we're looking for some trading opportunities, I'm looking for some high profile names that have been under pressure, that are in the media as being under pressure. Of course, JCPenney's is one that certainly fits that criteria. Let's take a look at one that has been as a seasonal trade for the last 3 years. This will be the 4th year. Sears Holding, believe it or not. Sears Holding has just been a dynamic trade after the first of the year. After that January break, it kind of bottoms out and has a very strong move going forward. This is another stock that's similar in nature, is the same kind of story. And this year, I mean, if you take a look at where it was, 78.61 last year, all the way back down to $38. This stock, if you have bought that stock, there is no way you want to hold that. If you're making money somewhere else, you may want to dump that stock and take the tax loss credit towards your portfolio. So that's one that's definitely, in my mind, going to be still under pressure. So don't be looking at if you think it's a buying opportunity right now, you want to maybe wait on that one, and definitely don't get stuck in the hype that if it maybe rallies in the next week or two going into Cyber Monday, or it might be a selling opportunity, a short-term selling opportunity, or at the very least the rally might be capped there, okay? So the interesting aspect is that I don't think it's got a lot more downside to it, and I don't think it's got a lot of potential for an upside move either. And this is that category of stock opportunity that goes into the buy it after the New Year's. One of the things that I'd say that would suggest to me that it's not really going to go down much further. It'll just linger here, kind of like wasted dead money. But keep it's on a shopping list that you want to look for buying opportunity after the first of the year. Is it that it's forming a little bit of bullish convergence on the volume indicator? So we come into more of a seasonal bottom in here, but it doesn't really go anywhere. And I think that this is, again, another stock that it's performed quite nicely for, I mean, several years in a row right after, as you can see, in 09, right after the first of the year, in 2010 after the first of the year, you had a little one in 11, you had another one over here in 13. We've done this trade, and we've given this trade out to our trading community, and it's done quite nicely. And you want to be in, again, watching that seasonality. You want to be looking at that trade for maybe at the very least a stock replacement with an expiration of at least April timeframe. So after the middle of January, this Sears, get this one more time, here it is, 2011, HLF did the same thing, but you can see clearly the seasonality in this stock. Some years have been better than others, but almost every single year we've gotten a nice little move out of Sears Holding. So on a monthly basis, Sears Holding, very nice potential again this year, because it falls in that category of that seasonality of sell it going into the year for tax loss credit purposes. So there is some really neat trades that are kind of setting themselves up for, which I'm sure people will be hearing about it eventually on the news, but typically you hear about it after the fact. Like, I think, you know, what we need as traders, real simple, is better market analytical skills. And I think there's certain technical tools, if you use them correctly, will give you that analytical skill. Now, another thing, and by the way, Herbalife, Tom P., thank you very much. Herbalife was one we did last year, and I know that we had several people in our trading community. If you guys remember, Herbalife was another one that we did. Herbalife is one more that's on the list. I kind of jumped and gave the secret out. I was going to share with you Herbalife as well. Herbalife is another one, believe it or not, that has that same technique over and over. So there's certain stocks every single year, they just pop up on the list. Now, will it happen again this year? I don't know, but it's got my attention, and it might get your attention. It should get your attention as well. So certain stocks, once again, when they're down going into the beginning of the year, they tend to stay down, and then right after the New Year's, you start looking for some buying opportunities, or at least look for, if they're fairly optionable, look for bullish option strategies, and you can get a little bit more directional with those. The longer they stay down and the more pressure that they have to the downside going into the beginning of the new year, the better the pop to the upside. Now, not all year is created equally. That's number one. And number two, some years are better than others. So you definitely have to manage the trade without a doubt. Okay? And the best way I know how to manage a trade is strictly by getting into a full position at once and scaling out as the market moves in your favor. I just don't know if a market's going to stall or continue to blast off, but if I scale out, and typically what I'd like to do is scale out in a quarter position. So in other words, if you bought, like, say 10 options, you can't get out of 2.5, so you either do 2 or 3. So if you're going to get out of a quarter position on the first exit, you get out of 3. And then if you're going to get out of another quarter, then the next time you only get out of 2. And then as you're going to get out of one more quarter, if the market continues to rally, you liquidate a little bit more. Then you're left with, maybe the discretion's up to you. You're left with your runner, as we call it, 2 or 3 options left if you're doing, multiples of, say, 10, something that's not exactly divisible by quarters, all right? And that's why we refer to what we need in trading is we need good risk management techniques, and we need proper position sizing. The old adage is that, number one, whenever you're wrong, you're always in 100. Whenever you're right, you're always in 1. Well, if you learn proper position sizing techniques, or you got to understand, not every single trade is going to be a winner. We don't have every single trade as winners, but we have a lot of our trades are manageable, and a lot of our trades have defined risk. When we get into more directional stock replacement strategies, like we just did Cisco and we just did Amazon. In fact, many of you may have heard us talk about Amazon. Let's see, we tweeted it, we did a presentation on it. We were there for Thursday morning before the open with TradeStation. Every Thursday I do the morning briefing. Every Thursday I do morning briefing with TradeStation, and we gave that setup out in TradeStation. We even posted on Twitter the trade analysis, as well as what strike price and options to look at. We were looking at Amazon for not just a seasonal trade, but it had great technical appearance, and more importantly, we were looking at carrying the trade through into the January expiration. Now, on Cisco, what we did with Cisco, it too had some great technicals, and so instead of an earnings play looking at the weekly option, what we did there was we wanted to trade the stock on its own merits, not just an earnings play. We felt that Cisco might have some more upside and follow through even after earnings, so we went with a stock replacement type strategy, an outright directional call for January expiration. So we're not just a one-trick pony where we do credit call spreads and credit put spreads if we're looking for a market to peak. We actually look at more directional market objectives, and our target price when we did Amazon was $355, and of course Friday, out of the box, we had an intraday high of over $332. So it was quite an exciting situation there. The key is, in any trade that you do, guys and girls, ladies and gentlemen, the key is, you got to participate in the trade, and you got to have a defined risk. If your defined risk is a monetary amount, that's fine. But in addition to that, many people, what you also need is, it's just not, hey, I want to risk X amount of dollars, right? I also have to risk, if you remember on a chart, you have 2 axes. You have price, and you have one that's called time. Time is of the essence. Time is money. So the funny thing is that if you have a setup and a trigger, and it should go and move in a certain time frame, right? So you're looking at maybe a weekly chart, and you have X amount of weeks, like 12 weeks. And you know that you have a setup that typically when a market breaks out, you have 2 weeks and you should see some type of a performance. Well, if the market goes through those 2 weeks and nothing happens, and your risk, you haven't risked the amount that you intended, it's just sitting there. Well, if the trade is supposed to go up and it doesn't, then what you do is simply you eliminate the trade and move on. But people think of risk management not in the terms of time. Most people think the terms of risk management in money. And so when you look at an option strategy and say, well, I'm going to buy an option that's maybe 100, let's round up and say $160 per option. Well, if you did 10 contracts, that's $1,600. Well, $1,600, I don't want to lose $1,600. Well, if you understand that, yes, granted, if something terrible happened immediately and the stock filed bankruptcy, the company filed bankruptcy, you could lose that $1,600. I get that. But what if under normal circumstances the company's fine and the market just, you get in it and it just kind of moves sideways and you should see a move that pops and over 2 weeks the market just keeps moving sideways? You know, do you sit with the trade or do you exit the trade? You exit the trade. That's a different form of risk management. It's a timing stop. So risk management isn't just all about money. People cannot just think in terms of one-dimensional money. It's not like, you know, hey, I haven't lost my, 50% of my premium, so I'm still sticking with the trade. No, you have to trade based on the condition or the pattern or the setup. You know, another thing that I've taught, some of you may, I'm not sure if there's people that were at the New York Options Conference. I spoke there and said, hey, I know you go to, everyone here has been to, wherever you've studied option courses before, and everyone knows about implied volatility if you've been to advanced options training. And when implied volatility relative to historic volatility or maybe the 52-week high implied volatility, if we have a very high implied volatility, you all know it's best to do option writing strategies. And sometimes when you have the market condition or the pattern, when you have a low implied volatility environment, it's best to buy premium. Well, I think you have to override that rule. Listen carefully. You have to override that rule based on the market condition. What is the market condition? Well, typically when a market has a strong trend, if it's a strong trend to the downside and it's been a pronounced prolonged downtrend, what happens? Typically you get into maybe a bottoming action. Sometimes you get these V bottoms and sometimes you get these choppy rounding bottom patterns, right? You guys have seen where you get a kind of a rounding bottom, right? What is that? That's a pattern that takes time. So if you're in a low IV, a low implied volatility environment, if IV is low and you have an opportunity where the market's been in a pronounced downtrend and all of a sudden you're starting to see a sense of choppiness, well, the market may not pop immediately. Some people, what they do in a low implied volatility is they'll put on what's called a debit spread because it's designed to be, you're buying that premium because it's low implied volatility. Well, guess what? According to options theory, that's what you're supposed to do. But according to the pattern, what you should be doing is put spreads instead. Because if you get into in a low implied volatility environment, the market might just linger here and you're in a credit call spread, and guess what? You might not make any money. You have a better edge. You might reduce your profitability by being in the strategy you should be in accordance to the market condition, trend consolidation. And if you're in that phase, especially in the beginning of a bottoming action, a debit call spread, a vertical call spread might not do you a bit of good. And even still, if the market bottoms out, taking in time or theta is the right strategy. So basically what we want to do is just find out, again, with time, there's a lot to trading when it revolves around price and also time. So again, keep that in mind. Risk management and position sizing and using the right strategy is accordance to what the market condition dictates. Now, how do you understand that market condition? Well, I mean, let's review. You get a trend, and then you get a consolidation, like maybe a wedge or a flag formation, and you know if the market breaks out of that, you know the measuring techniques should extend the move, and there's a measuring technique to get your objective to the upside. So that's how we get the ability, and that's what we need to do, is get that ability to anticipate those market opportunities. So understanding derivative markets like options and applying more option strategies, that is something that you as a trader have an obligation to learn. There's no doubt about it. So I think that this particular year has been, and the current market condition is very interesting in the sense that all year long we've been in, if you look at the VIX, except for back in October where the VIX finally spiked, all year we've been in a low implied volatility market, but yet at every earnings we've had incredible volatility on individual stocks. It's been, and many of you know this, it's been like a binary event, hasn't it, right? You got to guess whether the stock's going to beat or it's going to miss, and if it misses, maybe they give positive guidance and the stock still goes up, or they beat expectations and gave poor guidance and the stock got punished to the downside, or, it was up 3% or up 15%. I mean, or down 10% or down 6%. It's been a pretty wild individual stock environment. That's no doubt. And I don't think that's done. And so what you want to do is prepare for not this earnings season, because we're pretty much past it. With after this week, we're kind of done. We've got a lot of retail type stocks coming out on Thursday. Tomorrow's Target, I believe. We've got some coming out, but man, there's going to be a lot of great opportunities coming into that first quarter earnings event, and that is not that many. Believe it or not, we're in one earnings season, and we're not that many trading days away from the next big one. If you think about it, it's going to begin in the middle of January. So if you think about it, as I just pointed out, we're 28 trading days left until 2015 is over. Add another 10 or 12 trading days to that. Okay, so trading days, in terms of trading days, we're talking about 40 trading days away till the next earnings cycle. So if we can prepare for that, that's going to be pretty exciting. Many of you know the tools that I use are, of course, looking at, if you're using Thinkorswim, you're probably very familiar with the PPS buy and sell triggers. They're very dynamic. You can run them. I use a proprietary moving average to look for regression to the means, so for entry and setting buy levels against those moving averages. It's incredibly easy to scan for buy signals. It's incredibly easy to scan for sell signals. So with that said, it's a very dynamic momentum indicator in of itself. Of course, I use candle patterns. My high close, low close doji. The person's pivots, of course. Chart patterns. I've already alluded to looking at wedges and, of course, channels, different patterns, broadening top formations, which was one that we promoted and actually tweeted out to, I don't know how many people, many of you guys probably, if you're registered under those, I don't know if you get the tweets, but it's something, if you go to our website, I'll just bring it up for you. If you go to the website right over here, or not, there it is. Right on the side of the website, you can see all those tweets that if you just go, you can just click on the Twitter link, and you can easily sign up to get those tweets. Basically, what we do is we put out just basically trade information. And one of the things I think on photos, one photo that we put up here was the infamous, which I'll share with you in tonight's session, was that broadening top pattern in September with, of course, the divergence in the advanced decline analysis. And, you know, the S&P's only experienced a 10% correction. It was fabulous. So, you know, those chart patterns, and of course, looking at the volume, and of course, I use OBV. I have a histogram, and it's exclusive with TradeStation, and relative strength analysis. These are the tools that I use for analyzing different markets. For example, the commitment of traders data gives me a consensus opinion of what the market is or who's in charge of the market as it relates to commodities. As for stocks, indexes, we use a breadth analysis, and that's the advanced decline comparative ratio lines. Many traders do use breadth analysis, and I'm sure a lot of you guys like to look at the tick of the TRIN or the ARMS index, right? Just to give you an insight is that one of the I think the detriments, it's not like no indicator is perfect, but I think one detriment to the using that information is it's based off of the NYSE, the New York Stock Exchange Composite Index. And what maybe traders don't know, and this is finding out details, and the devil, remember, is always in the details. The thing is that over 50% of the stocks contained in the NYSE are both interest rate sensitive, as well as there are bond funds contained within the NYSE. So if stocks and bonds are moving up in a tangent, you might get a relatively a stronger than normal reading than you should. It could give you a false indication of the true undertone strength of the broad stock market. Whereas I like to utilize a advanced decline on the various stock indices, such as the S&Ps, the Russell, the Dow. We can create that, which we do and we have. So, you know, one of the things when we look at, just to share with you, and I think it's kind of important, what's been a little confusing up here at this point in time with the stock market, we had a great trading session in September and an unbelievable trade market in October. I mean, it was just dynamic. It was do no wrong. And in the last 9 days or so, this has been kind of a treacherous, tricky market because there's been no volume behind the S&P rally. There's been really no volume behind the NASDAQ per se. We've raced and roared to new highs, and we've got divergence there. Looking at the Russell, for example, the Russell is near its highs without that accumulation of volume there. And even looking at the NYSE, which, you know, the volume there has almost exceeded the last high, but price is below the last high. And that's why I don't really trust that the overall market activity in the NYSE. As you can clearly see what you're seeing on your charts here, and I share this in our trading room community, and we've done it at several different presentations. This is the S&Ps, this is the NASDAQ, this is the Russell, the NYSE, the New York Stock Exchange Composite Index, and this is the diamonds, the Dow Jones Industrial Average. So when we take a look at these, the top row is the daily, and the bottom row is the weekly. And clearly you can see, even looking at the Dow, you can see what I'm referring to by that kind of divergence and lack of volume. I mean, from the last peak, we've had an amazing, the last peak, of course, being September. Prices have made a substantial higher high move, right? In fact, we had mentioned even back in the day that this was a potential island bottom, one of the most bullish patterns ever to be seen by mankind. And yes, we had an island bottom formation right there in the Dow. But we also had a breakaway, a midpoint, and this could be kind of considered an exhaustion gap, but the market keeps going. The funny thing is as the market surges to new highs, there's no real volume associated with this move. So this is, you know, eventually something's going to change. The volume's got to catch up, or the price is going to have to pause a little bit, but it does give us the inclination that the move might be unsustainable, and it's a very light volume trade. So that's what I mean by the statement. It's been a little bit confusing in the last 9 or so or 8 trading sessions, because here we've gone from like 20 and a quarter straight to almost, 2055 area. I mean, just over that 2050 handle, and there's been no volume behind it. And for once, you could see that even the volume histograms kind of reflecting that lack of volume in that upside move. The advanced decline on the S&Ps, just to give you a little insight here, it has seen an increase. And so that shows that there's strong breadth, but again, it's on light volume. For a healthy market, you want to see strong volume and good breadth. And we're missing that element. And it's not just on a daily basis, but it also exists on the weekly analysis, most importantly. So to me, this is a market that is susceptible for potential sell-off. And when it's coming, I don't know. But, I mean, you need to be prepared for the fact that there is, without a doubt, a divergence in the volume here. And so when could this come? Maybe after Cyber Monday, they're getting a little bit ahead of themselves with the Santa Claus rally or this, I think it's the market's just giddy over the government change in Washington. And that's really what this market, money's just chasing money coming into the market. Not all stocks are going up, and not all sectors are really performing well. So it's up to us to utilize the individual tools. I hope I'm not confusing you, but we have specific tools, and that's why I have this list. Certain tools do a certain job. If you want to know about the market, many people look at what's called price indicators, like RSI, MACD, stochastics, even Bollinger Bands. Those are all price-based indicators, right? CCI, a person's pivots. Everything is based off of price. So what is not based off of price is volume. What is not based on price is breadth analysis. That shows participation. So there is more dimensions of analyzing the markets to give us a better clue. It might take a little bit of work, but by gosh, it certainly does pay off. So this CFTC Commitment of Traders report, I mean, we've shared this with you many, many times. It was one that really gave us not only additional confirming information, it was dynamic in helping us to uncover that potential sell-off that was due as we headed out of September into October. Also, we gave this one as another example of what we did with the folks over not only in our trading room, but also with the Thursday, Trade Station Thursday with the morning briefing. We said, hey, the COT data, you got small speculators short the market, a rise in volume, and this market had a nice surge to the upside for a nice little trade. So the Commitment of Traders report is important, especially at specific turn points. It shows that if the student body is all left, if the small speculator is all long or the small speculator is all short, and all of a sudden you got a turn, it shows that there's ammunition, fuel, so to speak, for the fire to get a little out of control. In other words, if everyone's short and the market starts to go up, there's going to be more short covering rally, and therefore you're going to see a faster, more pronounced move, and it's great for directional trades. So anyway, those are some of the tools that we have to our disposal. I constantly talk about them, and yet I'm not sure a lot of people still utilize it, or they don't find value in it. And I got news for you. It really is instrumental, especially if you're trading some of these commodity-based ETFs like for gold, for example, GLD, silver, SLV. S&Ps would be the spiders, so you want to look at the ES, the E-mini S&Ps, and all of that information is available by taking a gander or look at the Commitment of Traders report. The other things that we look at is the person's pivot indicator, which is a powerful tool. It helps uncover those predetermined support and resistance. Now, I tweeted this out. You can go and spend some time, go back and look at the photos. I actually snapshot the photo and said, hey, we've got not just a broadening top pattern in the S&Ps on a short-term basis, but we also had one on a larger degree time frame, and we had bearish divergence in the advanced decline. In fact, even the volume analysis was suggesting that this market was running out of steam, and yes, we were prepared for it. Many of you that are in the room right now got positioned on puts with this exact pattern. I know half of you guys that are all in black had opportunities, and we did prepare for that downside move. The amazing thing is, you remember, we actually even promoted that our spider target, or the price target for the spiders, was 185. It was based on a confluence kind of with the monthly person's pivot. That's that green target level, the quarterly pivot support, and also, more importantly, that downside trend of that larger degree broadening top pattern. I actually did a presentation. Many of you probably were there, and someone said, oh, I've heard of it called a megaphone before. And I kind of went on to say, well, the actual correct nomenclature is a broadening top or a foghorn pattern, because that's why it was written back in the the early back in the 1900s when technical analysis, the old school books were written. So I just like to reemphasize what is the correct way of saying things, rather than people renaming something that already exists, right? So the moral of the story is that some of you may have even attended that presentation. If that you may go, yeah, I think I remember something about that. Well, this analysis, based with those indicators, is what has been working significantly well in what we do. In fact, we actually put out, not only did we cover our shorts by with the puts, we liquidated our puts. We got real lucky on a lower price opening that day, but then 3 days later said, hey guys, we got a tremendous support, and it looks like a relative strength performance. It looks like now's the time to get into the Russell, and we flipped and bought IWM calls. Looking at this fuchsia or pink colored line, this is the advanced decline of the actual Russell 2000, as it is illustrated here as the ETF known as the IWM, which reflects the ETF on the Russell 2000 or small cap growth stock sector. In fact, notice that we have this little blue dot. That's one of the PPS buy signal. It's hard to see, but that's that green level. That's that, as you can see, monthly target support. So the market came near the person's pivot monthly target support, generated a buy signal on an increase, a significant increase in volume, and a nice uptick in the advanced decline or the participation rate of the stocks that are within that index. So if you were just looking at the NYSE, you may not have picked that up until several days later. That was another one that we actually tweeted this information out on October 16th. So that was pretty much darn close to the low. So we haven't been selfish and holding back with those tweets. You can certainly go and read some of those, and that's the neat thing about Twitter. It's something that you don't have to fumble with the internet and the server. It's just tweet this out, and if you sign up for them, you can get them. So it's something that's been working out very well. So anyway, that relative strength analysis, as I just pointed out, how did we pick the Russell? Because the Russell was outperforming the other markets. It fell the least on the way down, and it started to rally the most compared to the other indexes at that point in time. This is that relative strength analysis that we actually have, and as you can see, it's kind of color coordinated here, folks. And this might seem, for new traders, something different you've never seen. This is not in terms of price, but it's in terms of percent. And you take a point in time and you look at the percent change. Now, the Russell, which is in the IWM, which is in orange, I mean, at this point in time, the Russell is fallen from the early part of September. That's what this timeline is. From September, the Russell was already down 10%. And then all of a sudden, note that it started to go up, and the green, which is the S&Ps, the green started to go down. And so while the Russell started to go back up first before the green went up. And so that's where you had an edge in that time frame. From here to here, you already had an upsurge in the Russell before the actual NASDAQ. In fact, If you guys can see this, look through the colors here. You can see this very clearly. All right? So this is the low in the Russell. And if you note, there's the low, and which way the green is moving lower, the black is moving lower, and at this point in time going forward, the orange is going up. That's that relative strength I'm referring to. Relative to the two other markets or the two other indices, the Russell started to gain strength. Recently, just recently, over the last few days, the Russell is now back to underperforming the other broad markets, just as a note of reference for you guys. Now, the momentum indicator I use is that PPS indicator. It helps give confirmation of a potential change. So it's very important to me in my work to look for a momentum change, not just on one time frame, but on multiple time frames. And my two favorite time frames is daily and weekly when it refers to stocks. So if I'm in a weekly buy mode and I'm in a daily buy mode, that means the higher degree time frame is in sync with a shorter term and vice versa. Another thing I like to look at, of course, is that volume, which I consider without a doubt is the lifeblood of the market. Now, we use both the PPS indicator and I use a variation of the on-balance volume with a moving average component to help me look for directional change trends. And when I've got volume moving up in both time frames and considerable buy patterns or positive chart patterns or a PPS buy signal in the market, that gives us an edge. Not that everything's guaranteed, but boy, I'll tell you what, not many people, if you remember a few weeks back, QLogic, which who in their right mind was looking at QLogic? We were. JDS Uniphase. In fact, I even joked and I said, this is like a blast from the past. I forgot what the hell they did. I hadn't heard that name, but it came up on our scans, and we positioned for that market move. We just did Cisco last week. We're still in a small position left with Cisco. And, of course, some of you guys had already said that you were there when we did the analysis, and we saw a bullish setup for Whole Foods, and we had a bearish setup for Qualcomm. I mean, Apple's going up and Qualcomm crashes. I mean, it didn't make rhyme or reason, but yet the indicators that I'm sharing with you here tonight gave us indications that that would be the trend direction of the market. Those same indicators that I'm sharing with you right now, very powerful, gave us the lead and the trade direction for Amazon, which led to, I mean, I wasn't expecting in a snap of a finger that market to break out, and like it did, over 5% in just a matter of, I mean, less than a day. It's gone up approximately since last week, almost, believe it or not, 15%. So options on that, my idea was was looking for a target price of near 355 to 360 in Amazon by the January expiration, because that is one that does perform well from a seasonal perspective. And because we had such a strong pop in a very short period of time, we have scaled out 3/4 of the position, and we're just down to what we call the runner. This is my just a screenshot of what I'm referring to. If you've never seen this before, this is a daily chart. This is QLogic. This is a weekly chart. And it was, if you note here, you know, the market actually looks kind of on a weekly basis. I don't know if you guys can see this, but doesn't this look more like a rounding bottom pattern? Look at the volume. So as the market's kind of sitting there in a basing formation, so is the volume. They're not really interested in distributing that. They're actually accumulating that. Now, note the volume on the daily chart. It's going up when the market was moving sideways. That is a true definition of accumulation right there. Now, the PPS, you can note that we had a buy signal prior. There's that blue arrow prior, 2 to 3 days prior to the earnings before that thing shot up. And, of course, this is the weekly one. So we had great accumulation in volume on a higher degree time frame and confirmation from the short-term time frame indicator, as you can see here, which what led us to making that directional trade for QLogic. Again, the same analysis with, I mean, who would have thunk JDS Uniphase? But note that when the two time frames kind of line up, all you now need is that catalyst, and I can't predict what day of what hour or what minute the thing's going to finally move, but you can clearly see we had that little PPS buy signal, and we got a nice pop, and we had the accumulation of the volume here on a higher degree time frame, and that was what really helped us with JDS Uniphase. We've had several other trades. Whole Food Mart, you guys, if you were in the room, it is the same type of analysis where, here's the market that's moving sideways. I mean, literally, would you agree? I mean, that's pretty much sideways. Actually, it's from this high, it's actually in a small downtrend. So from that high, the volume is actually in an uptrend. So if you note that and you study that, you know what to look for. And that's the key, is to get the right education to know what to look for. What is this kind of telling us? It's fairly subtle, but you can see a little bit of market action is actually moving down and the volume's going up. The volume's not going down, the volume was going up while price is going down. That is a very bullish setup. And that shares with us when we see that, and on a higher degree time frame, it shows that the market is supportive. And of course, the market Whole Food had, 44, the thing didn't even stop there, but that was the day after the earnings. This is something that we gave we had that open house that some of you had participated in, and we gave that information. I'll never forget, someone said, does he do this type of analysis every day? And the answer, some of our students said, yeah, pretty much. This is the kind of work it takes for us to do this analysis. So not all stocks are created equal. We all know that. So maybe I'm just lucky and I'm just looking for just going with buy signals all over the place. Well, we had to analyze that. If you note here, Qualcomm had a nice rise prior to earnings, and yet there was no volume associated with it. As the price is moving up 1, 2, 3 weeks in a row, there was no volume associated with that move. It led us to believe that there would be some downside action in Qualcomm. So no, it wasn't just luck by chance that we flip coins and only take buy signals. It's definitely, the analysis there is very helpful. This year we've had a lot of trades that we've taken, and of course in Amazon, and of course the Russell calls, and looking at QLogic and Spider puts and Whole Foods, and we've just been all over the board in a lot of different positions. And of course we've done Apple, and earlier this year, like I said, we had JCPenney, which was a nice trade. So there's been a lot of different trades that we've done in the marketplace and taken advantage of those options. And I just want everyone to understand that when we sit there and do this analysis with you guys, it's difficult to teach and trade at the same time. And sometimes I get a little selfish and I'll go silent, and because I need to enter orders. I'm not sitting here twiddling our thumbs and whistling Dixie. It's definitely a hard job. And I have a lot of respect for others that are trying to help people that are in need of help, because the markets have been fairly tricky this year. Even for professional traders, it's been fairly tricky. But I think we've got, for the most part, we've got our finger on the pulse, and we've got a good systematic methodology that we use a good combination of tools. It's just a matter of being able to get executed, because we have some analysis and we just can't get filled. We do analysis and then we just don't see a good edge in the market. And then we get in a market position, and we're going to have some losers. It happens. So if you can manage the losses and have defined risk strategies, and of course when you have those really high probable, and this is when you hear, hey, I've got a high probability setup, it's because it's got kind of like all the stars lined up. The volume analysis is looking good. The PPS indicators are looking good. There's an earnings report. There's something coming out. There's a peripheral report coming out. This is the type of analysis that we do, and it's not just hidden, behind the smoke and mirrors, hidden behind the screen. It's teachable. That's what's really cool. It's teachable. And everyone here, that if you guys have had kind of like, well, I don't, it's not been a great year, or if you've been struggling, or maybe, a lot of people have found themselves to get into poor trading habits, meaning, you shouldn't get into the trade, but you do it anyway because either you're bored or you feel the need, like, I'm going to outguess the market. I mean, people do that. You're a human being. But if you can wait and learn to trust your indicators, more times than not, they're right. And so that's one of the things that you got to learn how to use them, and then you got to learn how to apply them and turn that analytics into profits. That's the key. You have to be able to do that. So that's why we rely on this seasonal analysis in addition to that. Now this year, I just wanted to point out to you guys, this year is a little bit interesting in the sense that typically the market goes up, and then right about the middle of November, the stock market goes down, and we're not seeing that yet. But this is the time where the market, the overall S&P, has an annual detrend that moves down. Now, downtrends happen two ways. They either go down or they move sideways. And so far, the trend has been up. If you're looking for the market to go down, it's not been pleasant. It's gone up. And if you've been looking to get short, at the very least, if you've had your hands in your pocket, then that's a good thing for the last few days. That's a fact. And of course, certain stocks have done very well. But for day trading, it's been, unless you've been bullish and you're taking buy signals and buying the new high breakouts, up here, for me, looking at that seasonal tendency is very, for me, that's a very ominous situation. And the fact that I've already shared with you that light volume rally, to me, that's another big red flag. Just for your information, the Commitment of Traders report has been reflecting that the small specs are still still long the market. The small speculators are long E-mini S&Ps. Now, another sector that has just been blistering to the upside has been transportation. And as you can see, it's around the middle of the month. Transports, even, they're all making a big deal, and it's so advertised. I think even my mother, who doesn't trade, she's 80 years old, my mother knows that transportation stocks are doing well. So when she calls up and says, oh, are you in transportation stocks? I hear they're doing great because gas is cheap now. When my mom knows that, that's an overplayed sector. I'm telling you right now. And so the fact that we have a seasonal decline in the market, anyone that's going to ship for the holidays may have already gotten shipped, or it's been built into the market. So the transportation, and one sector that you probably want to watch for some weakness is the IYT. The IYT is an exchange-traded fund that you could look at if you're interested. The IYT is one that has that seasonality of maintaining lower prices or not rallying. It just hasn't peaked yet. So one of the things about seasonalities, guys, you need to remember is it might be a week early and it could be a week late. But over time, that market doesn't really, from the middle of or so of November, from on or about the middle of November, which is right where we're at right now, give or take a week or so, maybe it's a couple days, typically it does not see aggressive newer highs. So watch the IYT for weakness going into, or at least a pause. So I don't think you'll see a big sell-off due to the fact that who wants, that profit-taking might, you got to face Uncle Sam in just a few months. But it may stall. So maybe that's a credit call spread opportunity going into January. That might be too much premium, but maybe you could take some higher out-of-the-money options and make up for that duration that you have to sit through. Or just watch this until after next week as you get into just past this current option expiration, and we'll look for that for the December expiration. That might be a good setup moving forward, okay? Now, the materials, the XLB, we talked about the materials having a breakout, and I'm just going to sum this up real quick. In our chart page here, many of you guys that have this, we have our relative strength analysis and our spread charts. We had, and again, just proof in the pudding about where we combine indicators, pivots, and chart patterns. As soon as this populates, I'd like to share this with you because there's two things that we would be looking at. Number one, I hit the wrong page. It's multi-time. Bear with me 1 second. By the way, the EWG was one that we were talking about watching for an upside move, and we did get a nice little pop in the EWG. This is the material sector. This is a page that we put up our trades. In fact, what we had was this little comments. So what I do is I put these on the charts and I upload them to those that have the Genesis package. We talk about this in the trading room. I said the XLB is relative strength weakness on poor on-balance volume, but the wedge and the seasonals can outweigh. And so this, like 48.60, we were talking about, when the market closes over that 48.60, you can see an upside move and a breakout. And that is the wedge formation that we talked about. Note that we did get the on-balance volume. The indicator crossed over that moving average, which shows that this trend is supportive. If you understand measuring techniques, typically you take the measured move, A, B, C, D wave, you're almost coming close to that objective up here. So, you know, this is a market that actually seasonally starts to enhance or kick into high gear on the 24th, and it already came into high gear a little bit early. So this is another example of combining and looking for those patterns, and as you can clearly see, a nice PPS buy signal, that green arrow. Interesting that it actually has been in a weekly buy since the week. That's that green triangle. It's already been in a PPS. Now, it's not a get-rich-quick trade, don't get me wrong, but at least you identify that the sector is breaking out. We identified successfully a point, a specific place that if the market gets above and closes above that level, then you can expect more upside. That's what that chart represents, and that's what those annotations. Now, the last time that I changed and altered that chart, you can see here, was on November 12th, which was, well, we updated it for a different market movement, but the market we did on the 12th, what was the 12th? That was last week, was probably looking at the Amazon trade as well. So these are the things that we kind of do in our room, and if you guys notice, we had Whole Food, Healthcare, Macy's. We just did an analysis on Macy's that, you know, here, weak on balance volume at monthly pivot with resistance for earnings. So watch for this one. We have weaker on balance volume. Macy's is, you know, forming that double top. We did that analysis with you guys earlier. And in addition to that, it's one that I feel that it's more indicative of a distribution top rather than an accumulation. So these are the kind of things that, just to share with you, we do and that we actually do use. So the material sector sees an increase in this time of year, and these are the main names that are contained in the XLB. So I want to give you guys, and I hope tonight you at least got an insight as to what we are going to come across over the next 28 and a half days between Cyber Monday, looking at end of year and the beginning of year. It's 28 and a half days to plan ahead. And with that said, I want to give you a very special, my pre-Black Friday holiday special. We did this summer, we did a mentoring class, 12 hours worth of class material. I want you guys to take advantage of taking this offer, which is just amazing, and this is how you can get started. Number one, you take these classes and then you trade along with us in our trading room of what you've learned from those live classes that was done and the material. And you study along and then you learn in our live trading room. All right? I'm in that room every day except for certain circumstances like either a surgery or a Traders Expo conference on Friday. But I'm in that room every day from 9 to noon. All right? For day trading, we use the the S&Ps, the NASDAQ, the Russell, the Dow, crude, gold, and bonds. We use 5, 15, and 60-minute time frames. We have our Monday weekly planning and scanning session, and you have access to those recordings. We actually put notes now. We have notes that we put down our trades, or that if someone's not in the room. So for example, you can see a note page that's in here, all the type of things that we're doing, like on the 11th here, Amazon, 355 calls. Look to buy in between those levels. Cisco, the Dan, 25 calls. Look to buy in between those levels. So these are the things that we post in the room as well. So that way, if you're not in the room the one day that we're doing a trade, I actually tweet it out and say, hey, come in the room and check out the note page, and you can have access to the room and just click on that note page and you can see what the heck's going on, okay? And so in addition to that, we are doing, and what these 12 hours of intensive trading educational course material covers, not just all the seasonal analysis for the majority of stocks, sectors, as well as the commodity markets, but also in-depth analysis on how to properly use the commitment of traders data, how to use it, how to find it when it's applicable. The complete A to Z on person's pivot analytics, price patterns such as the broadening top, and how to measure for wedge patterns, for example. What points do you use for the breakout? We have a great section on options and a section on binary options. My favorite strategies on those options: volume analysis, breadth analysis, in-depth detail on how to utilize these two indicators. And of course, relative strength analysis, how to compare one product to another. Trade management, how many positions should you be in, position sizing. Last conditional change, we didn't even get to that tonight, and we can't cover it all, but the last conditional change is an amazing way of looking at markets, as well as using it for stop placement. And of course, we have some of our favorite trading trigger entries for day and swing traders. We talk about certain bars for looking for breakouts, and then look for what we call a trilogy trade. 3 things have to happen. That's why it's trilogy. The trilogy trade, great setup for confirmed breakouts. Such as this week, if we're looking for selling the market, instead of picking a top, wait for the market to break down and confirm it's going to go down. If you can't get long, or you don't want to get long, then don't be selling until you have confirmation to get short. Now, this is all for being in the room for the month. The entire 12 hours of intensive trading education is just $689. This is our pre-Black Friday holiday special. And for some of you who are on a tight budget, we actually broke it down. So if you'd like, you can make a 2-payment plan opportunity for you guys. The outline is Session 1, seasonal sector analysis, market internals, breadth and volume analysis tools. Session 3 is the best way to use person's pivots, swing points, and chart patterns. Session 4 is option analytics and my top 3 strategies that I like to employ during specific market conditions. In Session 5, how to execute on specific triggers. What type of breakout patterns do we look for? Where to place your entry as a stop to get stopped into the market, under what condition and what levels. And of course, when we look for snapbacks, or what we call regression to the means, and placing limit bids for pullbacks to get long, or limit offers to look for retracements to get short. And of course, I think one of the more important elements of this is risk management, where to place your stops, the last conditional change, and of course, position sizing guidelines. How many options should you be in for the premium that you're spending versus your overall account? And a lot has to do with what the timing element is of how long you anticipate being in a trade. All of that, I think, is just an outstanding Black Friday special. And I'm going to tell you something. We give our weekly market observations out. I tweet these trade ideas out. We have those formal educational modules. We have the trading course material. You participate in the virtual trading room daily with me from 9 till noon, and we even keep the room open afterwards so that you can see the indicators on those if you don't have an account that has the PPS, so at least you have those time frames up with the PPS buy and sell signals. Now, if you want more information, simply go to personsplanet.com. and you can click under seminars, and I'll show you exactly where to get this information. So if you go to our website, the main website, and you can see where it says seminars right here. So you click under seminars, and it's real simple, pre-Black Friday holiday special. If you want to get started right away, just hit add to shopping cart. If you want to take this over 2 payments, because it is the holidays and I don't want anyone to, miss out on maybe a Black Friday special at Best Buy, for gosh sakes, we have a 2-payment option for you guys if you'd like to do that as well. And that's just go into the billing information and just check out, and all that will be taken care of on a secured server. Okay? So just if you want to pay all up front, just go ahead. Oops, I don't want to buy all of these. So just X out and X out, and just there you go. So my shopping cart is empty, and I have to continue shopping or go back, and that's how you get it done. So with that said, we've got a lot to cover in the next year, or the next year, listen to me, the next 28 days. The next 28 days is going to be kind of important. 28 and a half days, let me put that succinctly. The next 28 and a half days, shopping list for stocks, for possible tax deferment selling pressure. And of course, looking at the next, don't forget, this big seasonal event is the typical January kind of rally that you get. You'll get that January rally as pension fund money comes into the market, and then what happens after that? The profit-taking correction ensues, and then you got earnings season. So between now and, say, mid-February, there's going to be plenty of great opportunities, and I want you guys to know how to determine this information, to build the confidence, to see this stuff in action, so that you can get a feel for being properly positioned and taking advantage. We've got some great opportunities in the markets with the next, believe it or not, I can't even believe we just got through, we're not even done with earnings season, and we got, think about it, in 40 trading days, we're going to have another earnings season event. It's just crazy. It's like one earnings season after another. Anyway, I hope you really enjoyed tonight's presentation. I thank you all for being here. Again, take advantage of that offer, because it really was something we did over the summer. We did it over 6 weeks. It was 2 hours each week. We did it live, and so the material to go through it is just fantastic. And so if you like what we've been sharing with you guys, and you've visited us before, and you want to take your education to that next level, to learn this on your own and to see how it's applied, then take that step, make an investment in your own education, and take advantage. This is a great Black Friday holiday special. Keep in mind, just go to the website. It's personsplanet.com. I'm sure you all know exactly where to find it. With that said, I wish you guys a great holiday. If you're going to be in Las Vegas, I look forward to seeing you. We do have a booth there at the in the hall. I'll be speaking. I think I have 3 speaking engagements. I'm moderating a panel, and then we leave Sunday morning at some god-unawful hour. I think our flight leaves at 6 o'clock in the morning. We'll be back right here in the driver's seat for Monday's planning and scanning. And then, of course, it's Thanksgiving week. So it's going to be kind of an interesting week, that's for sure. We've got a cattle report at the end of this week, Friday. We've got GDP coming out, and all kinds of reports right before the day before Thanksgiving. So we've got a lot of exciting opportunities. I want you guys to be prepared for them and be looking forward to trading in the new year. So thank you all very much, and I look forward to having you under my wing as my new students, and as your mentor and teacher. I know I can help you guys, and this information is teachable, replicable, and you guys can perform. So I look forward to having you. Have a great 2015 with me here at Persons Planet. Thank you, everyone. Have a great evening.